broadcast is now starting. All attendees are in listen-only mode.
Well, good morning, and thank you for coming to our presentation today. This is Jim Guinan. I'm an Annuity Sales Director here with IAMS in Omaha. Hope you're all doing well today. Looks like we're going to have a nice spring weather here in Omaha area finally. No rain, which is nice to hear for us Nebraskans. But we want to thank you for taking the time to attend our webinar this morning. Our topic is annuities versus CDs, and we'll be talking this morning about some of the features of each of those products that are out in the marketplace today, the bank instruments versus the annuities. Kind of talk to you a little bit about some similarities and also how they're different and how you can position annuities in this current marketplace. So we'll be spending some time with that this morning in a few minutes. First, I want to talk with you a little bit about what's new here at Insurance Agency Marketing, and also remind you that our webinar is recorded. It's being recorded today. So if for some reason you aren't able to attend the whole program, or you get a phone call and you got to take care of it, we understand. We do record the webinar so that you can tune in on those later. That will be available late morning, early afternoon. So we do appreciate your time, and hope that there's some material here that can help you in the coming weeks. The timing of my webinar is usually at the springtime and fall for a particular reason. So I want to thank you for attending. With that, let's get started. I want to talk to you about some business builders here at IAMS. Many of you are familiar with, but for those of you that are not, we have really three core ways to help put money in your pocket as a producer, whether you're a new producer or an ongoing. The ongoing way, of course, is through marketing reimbursement and the referred producer program. So if you understand the power of referrals in your business, it's the same here at our brokerage. So if you have individuals that are out writing the life insurance, fixed annuities, and they're not happy with the service that they're getting at their current IMO, maybe they're not accessing all the products they would like, things like that, let us know who those people are. We'll be glad to follow up with them and give them a call and provide them the best service that we can. So again, we will reward you when that individual contracts, and then ongoing as they write business. Nice thing here, it's not limited to one producer you get an override from, so to speak. It's unlimited, so you can refer a number of people. Our marketing reimbursement program continues to grow and be successful. So as you write business with us here at IAMS, we continue to throw dollars into our marketing reimbursement account for you, which you can redeem with your business expenses. So give us the receipts, we'll reimburse you 50% on that business expense. Our new producer bonus I mentioned a moment ago, that of course is for those individuals that write business in their first 180 days of contracting with us. So as you approach that 6-month period, these are the thresholds that you can obtain a reward for. Many individuals like cash, but there are other things that you can take advantage of to help you in your practice. So again, our way of saying thank you for placing business with us. We know you have a lot of choices out there in the IMO world. There are a lot of brokerages. So again, our way of saying thank you, to put some money in your pocket right away to get you started. You could turn around and use it for whatever you'd like. You can use it for vacation or whatever you like if it's cash. Our back office support here at IAMS is, as you might guess, is a big part of what we do. Again, there are a number of team people like myself that work in life marketing, annuity marketing, but we rely on the same people that help you. And so their goal is to take the pressure off of you, spending time following up on cases, figuring out which products are going to work, all of that. Our job is in essence to become a home office for you, so that you can do what you do, which is, set your appointments, go see your people, and sell. So again, our job here, from the moment you call in and say, I need help with a case, I don't know what product fits, what's available for me in my state or for the age of this person or the health of this person, whatever the case may be, we will find the products, we will get you the illustrations. The apps come in, we will scrub those apps, and then we follow up with them the best that we can. So again, that's really a minimum expectation of what an IMO should be doing for you. Our creative department helps agents with a number of things, as you can see on this screen. They do now a lot more branding than they have before. We get a lot of requests for ways to brand the business, to maybe tie in. An agent might have a website, might have a business card, but maybe sometimes they're not connected. So website design, email marketing, any of those needs you have, give Jacob and his team a phone call. They'll be glad to help you, see if they can't work out a plan for you in that area. Our website is www.iamsinc.com. That's IAMSINC.com. If you have not been to our website in a while, you might want to do so. We do have a number of tools on there for you as a producer that help you around the clock. So even when we're not around, you can still find our rate book. You could get term quotes. You can find our webinar calendar. And of course, our sales resource library is a whole library of information, financial calculators, fact finders, all sorts of things can help you, and it's all agent oriented, of course, to help you in your business. Our current annuity book, as we call it, we have it at our desk. It's posted online. It has our most every carrier that has any good products at all is on that book. So our top carriers is usually 2 to 3 products. Their top selling products are available. Our multi-year rates are available. And then also there's a section on income riders to give you an idea of what they currently have at those carriers. So fees, roll-up rates, things like that. So again, a lot of information you can find. We use it also every day. I go to the website every day for assistance in helping me find products and run also income rider comparisons, for example. I want to talk to you a little bit about IAMS Wealth Management. For those of you that may be looking at growing your business in another direction, if you have an interest in Series 65 licensing, we'd be glad to visit with you. Charles and his team at IAMS Wealth would be glad to tell you about how you can make more money utilizing this license and growing your practice in accessing clients that you may not have worked with before. So if you have interest in this and like to get information or maybe a phone call, please let us know. I will put out a questionnaire there if you'd like to know more about what it costs to get the license, what's involved. They'd be glad to tell you the whole strategy here of growing your client base and in areas that you might not have known about, and also, of course, increasing revenue. That's the goal here, is to grow your business and any recurring revenue, I might add. You can do this also, of course. We don't promote it enough, but many of the carriers that we're working with on the fixed side offer a trail commission, which is a recurring revenue. So you can do that with fixed products, but it's definitely a part of what a registered investment advisor does. So if you'd like to get more or get some information about IAMS Wealth, please respond to the poll question that I have out there, and we'll be glad to follow up with you. So I appreciate your response to that. Moving on, want to talk to you about our Life and Annuity Academy, our 2-day producer training. We just completed our first program of the year. We do have our next one scheduled for May 8th through the 10th. And so we'll be looking at approximately 30 producers for this training. If you're currently in the marketplace, currently writing fixed business or life insurance, and would like to be a part of this, it is an all expense program. It is a Wednesday evening through a Friday at noon schedule. So we pack a lot of information into that 2-day, it's really a 3-day, but 2-day training. And we are looking for interested agents. So we are taking registrations now. We would we'd be glad to send you more information on the Life and Annuity Academy. I believe when we email that, there is a sample agenda. If there isn't one included in it now, we can get you one. But again, we just completed our first one. This is early May. There may be 2 more, but for sure 1 more of these yet this year. So if you want to take advantage of a, I think one of the best training sessions you can go to. I've been a part of several of them here in Omaha. And again, a lot of valuable information. We have top producers of ours that come in, talk to you about seminar selling, for example. They talk to you about how they have been successful in their business, and you can visit with them. You have access to some of our top carriers through these trainings, but it is not a product only training. So I want to put that out there. Its goal is to not just inundate you with product. You can do that on your own, but it is there is some to that, but mostly it's ideas of prospecting and how to step your game up in sales. So again, if you'd like to be part of that, like to know more, if you've been to one of these trainings before, by the way, and you're on the webinar today, we typically do not re-invite agents unless it's been several years since they've been here, because it doesn't change that much every year. But we do introduce new ideas, what is updated every time, but we would prefer not to have agents that have been here in the last couple years. So just want to mention that. I appreciate your response to that, as always. So just moving on, I want to talk to you about, lastly, our marketing summit, which is the period of time is coming to a close soon. The 2019 marketing summit, which will be held in Florida in August of this year, is both a educational and a social event. And our again, our qualification period to get invited is coming to a close here at the end of June. So if you've written business with us, for example, you should be getting a report on your standing and where you're at with that. We will have a very good group of agents here. This could be one of the better attended ones that we've offered. So again, beyond that, the next one, I don't know much about yet. I haven't heard where and when exactly, but we want to continue to offer this, a great way for us to both reward you, again, an opportunity to meet with agents that we talk to every day. So again, thanks for your business, and if you have further questions about that, let me know, or one of our other marketers. So with that, I want to move to our presentation topic today, which is annuities and versus certificate of deposits. And so I just want to kind of give you an overview, and then we'll talk about some comparisons of these two. Of course, annuities and CDs are both savings vehicles with a better rate than, say, just a checking or a savings or a money market. In some instances, better than a money market. But again, a certificate of deposit is a time deposit, as they say, does usually offer a little better rates than just very liquid accounts. But as we look closer at these, in many instances, an annuity will have some advantages over a certificate, especially if the goal is long-term growth. So as we look at this closer, we're going to compare three main areas of these products: accumulation, tax deferral, and cash accessibility. So let's talk a little bit about the accumulation part. Okay, so generally, I'm going to go back to this screen again, sorry. When we talk about accumulation, let's talk about a little bit about the certificate of deposit. Most CDs are issued with shorter maturity periods, usually as short as 1 month. Oftentimes, though, they're issued with a 1 year, any combination of 1 year and so many months, but they can go out several years, even 5 years. Depending on the rate environment, the last few years prior to this last year, most certificates were shorter term because the rates were very poor and no one really wants to lock in for a long period of time. Of course, stepping back further here, a certificate is usually issued by a bank or a credit union. So it is not tied to the financial industry like an annuity. It is a banking instrument or a credit union. Savings and loans issue certificates of deposit. So again, they're shorter term maturities. The return on a certificate matches the term. So if it's a 1 year, the rate is guaranteed for 1 year. If it's a 3-year certificate, the rate is guaranteed for that term. And of course, they're really more for a shorter term objective. So the purpose today is not to tell you that CDs are no good, you shouldn't have any money in there. But what we do see from our agents, what we hear from our agents, what I've seen with clients that I work with is oftentimes, for a lack of knowing where else to go, money's deposited into a CD and it's really for retirement or healthcare or other needs that are longer term. And for a lack of knowledge of where to go with that money or what to do with it, oftentimes it's just deposited in a certificate of deposit. So again, they're ideal for shorter term needs, maybe a purchase of a home or a purchase of a larger dollar amount with a short term horizon. It does make sense. That's really what they're for, is for guaranteeing a return better than sitting in a savings or checking, and with a shorter term objective in mind. So annuities are issued by life insurance companies, and they are really designed for longer term than a certificate. They are usually designed with tax deferral for longer periods of time, with a potential objective of driving or providing, I should say, a future income need. So again, you can issue, and there are annuities you can buy with short-term objectives. That's true, but eventually the goal is for a longer term. Okay, let's talk a little bit about tax deferral. This category, what we're going to discuss here is that a fixed annuity, whether it's an index or traditional, any kind of fixed annuity, is by nature a tax deferred product. So it means that there is no tax document generated every year unless there's a withdrawal taken. But as they are set up to defer, it automatically reinvests the interest or the gain, and there is no tax document generated because it is tax deferred. So unless an owner requests it, it will continue to be so as long as that product is issued. Certificates, for purposes of what we're talking about today, which is non-qualified money, are not tax deferred. So they do generate a tax document every year, whether your individual takes the interest from the certificate or reinvests it. Either one, it still generates a tax document at the end of the year. So there's an advantage. That's a huge advantage for someone that's planning on using this money for the long term, potentially for retirement, to not be taxed on it every year in an annuity is a huge advantage. And we'll talk about the triple compounding effect of that and the advantages of that over a long haul in a couple more slides. Let's talk about cash accessibility or accessibility. CDs do not have a withdrawal privilege. You cannot just go in and say, I want my interest or I want a 10% withdrawal. If there's a short-term need for that, what many people do is they may structure certificates at different maturities so that they're coming due and are then accessible. So if structured properly for a potential emergency need, CDs can be accessible, but as a financial instrument, they do not provide any liquidity. An annuity, on the other hand, does have can have a shorter term that would allow it to be free sooner, but within that, many offer a withdrawal privilege. It might be interest only. It might be up to 10% of the value of the contract, and that's with almost every fixed annuity out there. There are a few that don't, so we want to know about that, but as a rule, fixed annuities have a built-in accessibility. Okay, so let's do a side-by-side here, talking about some different features and benefits. I want to talk first about loss protection. Well, when we talk about loss protection, CDs are currently insured by the FDIC, Federal Deposit Insurance Company, or corporation, I should say, up to $250,000. I believe that's still the right amount. I know it changed a few years ago, but it is fairly high. I think it used to be $100,000. So annuities do not have FDIC because they're not a bank instrument, but they are backed by the company that issues them. So each company that does business, say in the state of Nebraska, or really anywhere, it doesn't have to be state of Nebraska, those companies are required to have a surplus. So for every dollar of premium, they have to have more than $1 in surplus. Let's talk about withdrawal privileges. Well, we kind of mentioned that a little bit ago. Certificates don't have they don't have a liquidity provision. You can't go in and draw money out. If you do, you're breaking the CD and there'll be some interest penalty. Annuities do have a withdrawal charge. Excuse me, this is talking about surrender charges. CDs have penalties if you take money out. Excuse me, I'm in the wrong category here. So certificates do have penalties anytime you take money out before the grace period of that or maturity. With annuities, they do have a withdrawal schedule. Again, you can design products or find products with 2-3 year terms, 5 year. If you do withdraw money out in excess of the penalty free, there would be a surrender charge on those. So they're very similar in that regard. We talk about access. This is where I was going. CDs, again, don't really have access other than they can be designed for very short term and taken out. Annuities usually offer a 10% or a interest-free penalty withdrawal feature. Effects on Social Security benefits. Well, interest on a certificate is counted toward taxation on a Social Security benefits the year it's earned. That could lead to higher taxes. Interest on annuities, of course, being deferred, there is nothing that counts negatively towards Social Security benefits. On taxation, already mentioned this, but certificate interest is reported and taxed the year it's earned, whether withdrawn or not. Annuities are tax deferred, and their interest income is not reported. Going a little further with this, talking about some other benefits or features. So, annuity versus certificate of deposit. Well, we talk about free from principal market risk and fluctuations. Yes, that's true for both of these instruments. Interest earnings are free from current taxation. Yes, with an annuity, not with a certificate. Again, limiting our discussion here to if that CD was non-qualified money. If it's IRA money in a certificate, then yes, it would also be deferred. But interest earnings are reinvested automatically. Yes, with an annuity, not with a certificate. And then tax liability on Social Security income, we already touched on that. Talk about liquidity. Annuities are liquid in their flexibility or their withdrawals. Certificates, you can get money out. There will be a penalty, but you could, they're relatively liquid. Flexible, what they mean here is flexible premium. And when we're talking about flexible premium, most fixed annuities are flexible, but more and more are issued single premium. And a certificate is not flexible, so you can't add to one. You could certainly take out future certificates. That's usually what people do when they have additional money. They just go to the bank and get another, they purchase another time deposit certificate. But you can't add to it once it's been issued or written. The annuity, it may be. Taxation on withdrawals. So is there taxation on the withdrawals of an annuity? Here it's talking about penalties, but the answer to the question is it may be. It just depends on whether that withdrawal represents gain in the contract. But generally speaking, when you take money out of an annuity, it is taxable. You take money out of a certificate of deposit, it's not taxable as such. How are they secured? Again, we touched on that. FDIC is insured up to $250,000 with the bank. The annuities are backed by the full faith and credit of the insurance company and by state regulations. All right, so let's give an example here. This is a useful, I think, examination of how to talk with one of your prospects about reducing taxes with a CD rollover. All right, so this is something to talk to you. This is another way, rather than just tell them the comparisons that we went through. One way is to talk with them about their tax return, the 1040, and you can illustrate this diagram on paper. I think this kind of helps a little bit. So you can see at the top you've got bank CDs. What does it generate? Well, on line A of the 1040, it does show the interest income that you're paying on your bank CDs. So what are some possible moves that we can make with these dollars to eliminate or reduce, if that, what's on line A? So what we look at are tax controlled accounts, and some of those tax controlled accounts would be going into a tax deferred annuity. So you've got instantly a savings and also a better return. And, again, you're not getting a tax document generated. And also into a secure investment, diversification of the retirement dollars, and maybe some other benefits and features we don't even talk about here, but nursing home liquidity, terminal illness rider. So all those things can help make that annuity even more liquid in certain environments. So some other accounts other than CDs that could provide benefits in addition to better returns potentially would be IRAs, maybe to increase what you're going into your 401k, life insurance, cash value life insurance. So again, there's a number of things you can do. They have to make sense on the other side, as well as just the return and what those benefits are providing, or what those products are providing, I should say. Okay, so let's talk about the power of triple compounding. What would your clients prefer here? So there's some options here for individuals. We know they have lots of choices. So let's talk about the interest on your principal, the interest on your interest, and the interest on money not lost to taxes. That's the power of triple compounding. So in this example, we're going to assume, as it says at the bottom, a 7% yield and a 33% tax rate. Again, we can use any numbers, but the result will be similar. So in our first example, um, where interest-bearing accounts, they do generate interest on your principal, but if you're spending that or taking the interest growth off the top, you're not gaining anything. So that's true with really anything. At the end of a certificate term, you take the money off, you still have the main principal. If you have an annuity and you take the interest that it's generating or all the gains out, you're not going to grow the money. But interest-bearing accounts generate pretty low interest, and if you're taking it, you're just not getting anywhere. In the second example, or the second box here, it says, on the other hand, if you reinvest those earnings to earn, if you reinvest the interest you earn on it and you let it grow, that money is going to grow over time. And if the interest, let me get to this. If the interest is earned, is reinvested, and is untouched in a tax-deferred annuity or vehicle, it makes the money work even harder for you. So again, compounding is important. Not touching the money is one thing, but letting it grow and also having that reinvest in a tax-deferred vehicle, that money will grow even more for you. So again, this is non-qualified growth versus tax-deferred growth, illustrated, and again, over a number of years. So let's go to the point of the conversation with your prospects or clients where this may come to a discussion. So you may be having annual reviews. You may be sitting down with annual reviews with existing clients. You may be on an appointment with someone for the first time and you're getting your fact finder, you're filling out your financial review, what have you. And hopefully there's a section on your fact finder that talks about certificates. And I think a couple key lines on this is the maturity date, second line down where it says your CDs. So when you're trying to find out more about your client's financial picture, do you currently own, where do you currently have your certificates? You can formulate that in a number of ways, but what do you typically like to invest in? Shorter term, longer term? Really, what's the maturity dates that you usually like? What is your goal for that money? And is it earmarked for something in particular? Is it just additional dollars that you have in the certificate to try and get a little bit more than a savings, but you don't have it necessarily using for something in the near future? I mean, those are all questions that you want to know, as long as they're willing to talk with you about it. So finding out what that's for and what it's earning and how it's performing and what they will determine whether this is a piece of business for you now or a year or two from now. So again, it's identifying those certificates in the bank, what they're for. If it's for something liquid, leave it alone. They know the returns aren't great. Everyone knows that. Again, finding out how they feel about it. Maybe in the fact find they have an existing annuity contract somewhere that they're not happy with. That may be your easier piece of business. We're in the time of year where this discussion should be on your mind with everyone you talk to. Between now and the end of April is the largest CD renewal period of time in the year. So we want to talk to people about what they're, if you've talked with them before, talk to them again. I hope this helps a little bit with you educating your clients on the advantages of annuity, where it is suitable, and now, of course, it's up to you to recommend the right product. I did want to give you some rates, by the way. I always do this with this webinar. If you've not been to, you want to write this or go to this. It's bankrate.com. It's a great website, and it has all the current rates. There's some financial calculators on there. I really like the website. Bankrate.com, bankrate.com. I went out there this morning just to kind of update on rates. You can plug in, basically type in like the maturity date of rates you want to find. Many of the rates they quote are online banks. So I want to tell you that up front, that some of those rates are pretty good, but they're online banks, and your average consumer doesn't necessarily use those. So this morning they said the national average for a 2-year certificate, the national average is 0.94%. So not even 1%. I don't have a lot of annuity carriers with a fixed rate guarantee of 2 years, but I do have one or two, and one of them is currently at 2.85. So we do well against the certificates. The national average for a 5-year certificate is 1.44. So those are national averages, 1.44. We have several companies with 5-year rate guarantee annuities at between 3.7 and 4%. So we not only have carriers with fixed annuities backed by the full faith and credit of their company with rates that are better, but also tax deferred. So we have a lot to talk about with products that mirror what CDs do in many ways. So those were the national averages. I thought those were low, but it said 2-year at 0.94, 5-year at 1.44. The best 3-year rate, when I just plugged in like 3-year certificate, said it was 285. That seemed a little bit more competitive. I do have a 3-year rate with one of our carriers at 3%. So again, we have fixed annuity rates that are better. And they said, and when I asked for the best 5-year certificate, online bank or whatever, it came up 3.1. Again, my best 5-year is 4. I have several B++ or A rated companies at 3.7. So, ladies and gentlemen, we need to talk about, I know that one of the pushbacks is that, well, I don't make a lot of money on a multi-year rate annuity. You're also not tying the assets up very long, and it gives you an opportunity to resell that when it comes out of maturity. So I realize that you don't make a lot of money on that, but you make nothing if they keep the money in the bank. So again, those are some opportunities on the fixed annuities. Couple other notes here, and then I'm finished for the day. There are a lot of deposits in CDs that are IRAs. So in your fact find, you may want to also ask them, is that qualified money or non-qualified? And the reason I point this out is because when I was in the field and I started in the business, my manager said, you got to be an IRA expert. I think that's still the case today. You didn't know the IRA rules in and out. And one of the closing remarks that we used to make on appointments when I was starting out in the mutual fund business is why would you tie up long-term money into a short-term instrument? You know, if you're talking with a 45-year-old individual and they have all this money in certificates and much of it, well, maybe not all, but much of that money is qualified, you got to ask yourself, why would you have a retirement vehicle in a certificate of deposit? So that's a question to ask, to challenge your clients, and gives you an opportunity to get an IRA rollover. Some products that you can offer, again, we've been talking about fixed rate, multi-year guarantee annuities. Again, we compete very well right now, and we have for the last year and a half. We need to take advantage of that because that may not be the case. So call our team here at IAMS. Call me. we have great companies, many companies that offer fixed rates from 2 years to 10 years guaranteed. But that's not all. Many of our competitive carriers have short-term indexed annuities, 5, 6-year products. We've got Great American, we've got Athene, we've got a lot of carriers with shorter-term indexed annuities with fixed rates inside them on the fixed strategy that beat the CD rates. So be aware of that. And of course, not only is it tax deferred, avoidance of probate, competitive liquidity, they have other features too. They may have a nursing home rider. Again, those are all opportunities to capture assets that are not earning what they could be. So let us know what your needs are for your clients. And if you have any questions or needs in this area, you can certainly call me. Um, you may have an individual that you work with also here. We appreciate your business and the opportunity to offer you what's very strong out there. So again, we appreciate your time, appreciate your business, and I hope you all have a great Thursday. Take care.